The content discussed in this podcast is for informational and educational purposes only and should not be construed as financial or mortgage advice. Always consult with a licensed professional before making any decisions regarding mortgages or financial matters.
Welcome to the Canadian Mortgage Show. Here are mortgage professionals Alex Pang and Alex Shanks to cut through the BS and educate Canadians on all things mortgages and real estate.
Can't get qualified at a bank, then it kind of falls over to private lending and is really, at the end of the day, the last line of defense in real estate lending.
Welcome to another episode of the Canadian Mortgage Show. This is episode 47. Alex Pang here alongside my co-host Alex Shanks. Alex, we have a special guest today, Marc Alteman from Altman Financial. So Marc is a private mortgage broker exclusively representing direct private mortgage lenders in private mortgage transactions. He's been involved in the mortgage lending business coming up on 15 years and has placed hundreds of millions of dollars of his own money, maybe not, of private mortgage funds, and is very well versed in the legal and regulatory aspects of mortgage lending in BC. In his spare time, he and his wife are busy raising boys aged 2 and 4, doing a little bit of traveling and biking. Marc, welcome to the show.
And thanks for having me.
Thanks for coming here, Marc. And it's exciting just for everyone to know. Alex deals with Marc for private stuff. I also deal with Marc for private stuff, and we've never seen each other face to face. I saw that he was coming on the show, and I was like, "Oh, this is going to be awesome." It's we communicate over emails and phone calls all the time, but that's about it.
And nice to put a face to a name, and nice to finally meet you guys. And well, not quite in person, but over video.
Exactly. Yeah, as close to person as this industry feels like it is sometimes.
That's right.
Yeah. On a side note too, like Marc and I, we're both Canucks fans, and we've owned season tickets in the same section. And before I met Marc in person, he's texting me like, "I'm sitting behind you," and apparently Marc kind of knows what I'm look like. And then I look back, who the hell is Marc? And then he starts pointing at me. I'm like, "Oh, there you are."
You have a nice back of your head, you know. That's you know what that looks like.
Yes. I'm blessed with the hair. You know, our audience are general public. We don't have the high hoity-toity crowd, so it's just the general public. Can you explain to the viewers what private lending is? Because most people don't really know what that is.
Yeah, private lending is a source of capital for it's kind of like a last line of defense in mortgage lending, meaning if you can't get qualified at a bank or what we call, an A lender, if you can't get qualified at a B lender, which might be, credit unions or other institutions, and then it kind of falls over to private lending, and private lending is private sources of capital. So there's really two ways you get capital in the private market: either a fund and or direct private individuals. Can be a corporation that someone owns, or these are individual people that have capital, and that's where I fit. I fit not on the fund side of things. I fit on the direct side of mortgage lending, dealing with individuals who have capital that they want to place into mortgages. The reason people go into private mortgages, it's really an assortment of reasons. They might have low credit that can't qualify at a bank, or they might, their bank approval may have fallen through at the last moment and they need a quick solution to their purchase or, refinance requirements. There can be all sorts of reasons to go private, and we can talk about those situations at some point, but that's the general why private lending exists, and it's really, at the end of the day, the last line of defense in real estate lending.
And that's and the one thing I do see, and where I find people get confused of like the different types of private lending, everyone that hears it, they're like, this is a loan shark. They're on the side of the street. They're going to charge me 60% interest, and they're going to break my kneecaps if I don't pay. And that's where everyone gets very confused and scared of what that private lending actually means.
Yeah, I think that's because people don't understand it, and I think it's a industry that's, I mean, first of all, it's been around for a long time. I mean, I can say confidently, I mean, well into early '80s and probably '70s when private lending really started to exist. I know some of the people that the first timers in the business that were getting going in this business back in the day, and and then that's when, you know, private lending was there, title insurance came in shortly thereafter. Um, so it's and now it's become more mainstream, I would say. And I think where the industry gets a bit of a rep is there are you know, a section, a group of bad apples, like any industry, that have painted you know, painted the broad industry with a bad brush. You'll see all the regulations that have come in since 2018, and our regulatory bodies clamping down. And I think it's to you know, for obviously deal with the bad actors in the business as best as possible, but also create an environment where the industry is looked can be relied upon for a good source of capital, and it's and they can trust that they're building the public trust in the business.
Yeah. And that's where, I mean, it's showing people like this is where back in the day when you talk about investments and everything, people used to only have, they could go to the bank. That's all they could get for investments and that's it. Then there are people that start finding these other sources, and that's where private lending, people started making money that way. And like it's just now starting to become mainstream for like an average investor to actually start to get into it, where before you had to know someone to even get into it.
Right. And that goes for borrowers and lenders. And on the lending side, it's only in the last, I'd say since year 2000, as it really started really building up extensively. And now in the last 15 years, it's really blown up, and it's, you know, and now it's a multi-billion-dollar industry. I don't know the size and scope of the private lending industry, but it's but I know billions of dollars are funneling through it. So it's quite the business, and it, from what I've seen, the public's becoming more knowledgeable too in it, which is a good thing.
Yeah, Mark, can you tell our audience, so when you're saying like, yeah, private lending is usually the last resort, what are we talking about in terms of interest rates? And I'm hearing things like, you know, we know this, but our audience doesn't. What's a, you know, a first, second, and a third mortgage, and what interest rates can borrowers expect to pay based on that?
Well, rates vary, much like the bank. They're not exactly tied to, you know, the Bank of Canada rates, but they do flow with the, you know, I'd say supply demand of funds, and that goes with banks. Banks will increase their rates when they want to reduce demand, and supply funds gets perhaps a little tighter. They'll raise rates as well. So generally speaking, at least today, rates are kind of anywhere from, I've seen 5.75% for first mortgages all the way up to, I've seen 11%, 10%. It depends on the risk profile of the deal, a type of property, location, all those factors come into play with pricing. And then second mortgages, they're anywhere from, I'd say 8%, and then all the way up. It really depends on, again, risk profiles, scope of deal, size of file, size meaning the total mortgage amount that the borrowers are requesting, and those details all factor into pricing. So it's really hard to give a range per se. It's really dependent on the exact file, but that's a rough range.
The client, the location, what are they looking at doing with the source of funds? There's so much to it. And that's where, just for like people to understand, the reason why like private lenders, they're willing to lend is they're not financing the same way as a bank. They're not going to go up to 80%, 100% of the financing. they're limiting their risk. They're going to say, hey, we'll give you 50% of the value, because that they know if something goes wrong, they obviously can sell the property. And that's where they need to weigh their risk. Is the property going to take a month to sell? Is it going to take 2 years to sell? And that's where the rates, I know, come into play, and the fees and everything.
Yeah, and a lot of banks are bound by ratios, income ratios that they have to fall in line with. We're not subjugated to those requirements. We can lend based on the equity that a borrower has in a property. And while income does play a part of the adjudication process on a deal, it's not the main focus of whether a deal is possible. It would be more equity focused, and income is important to determine whether they can pay the mortgage and whatnot. So.
And that's where, talk about like interest reserves there, Mark. Like how does that work to protect private lenders and stuff?
Yeah, interest reserves is basically if you have a loan amount, and what we'll do is we'll hold back the payments for whatever the term is. So generally in private loans, it's a 1 year term. There are exceptions. There are 2 years, and I've seen 5 year terms. It just kind of depends on the lender you seek financing from. And what an interest reserve will do is hold back the payments for that mortgage and effectively prepay them. And so what it does is it shields a borrower from the requirement of making those regular payments, and prepays them. So there's no risk of default during the loan term. And then any unused interest reserve just gets credited back to the borrower.
Yeah, we talked about the borrower side. From a private lender's side, let's say Alex and we have a bunch of money, and we want to invest in real estate, or we want to invest in stocks or crypto and stuff. Why should we consider investing in private mortgages as an alternative?
Yeah, so private mortgages are a great investment. Real estate has always done well in BC specifically, and across Canada as an investment. And so this is a way to put funds into real estate without acquiring property and being a landlord. So it's a way to be involved in the real estate market on an investment side of things without ownership, which is nice. The benefit of mortgage lending, it's taxed at your personal rate, so it's much the same as like a GIC. But the upside is that if the real estate market comes down, it affects the borrower's equity, not the lender's equity in the deal. And so there's a lot of padding in before your funds would be at risk. Whereas if you're in the stock market as an example, and the market comes off or your stock comes off, you have a choice. You either have to wait and hope it recovers, or sell and take your loss. And so it's an and of course the stock market tends to be quite variable, and other forms of investments can be variable. Real estate, while it can be variable, as we've seen recently, but over time it's quite a very stable way and stable place to invest in.
Yeah, I've talked to some people about, like what you touched on, why invest in private mortgages. You touched it. Like it's a way to invest in the real estate market without the headaches of being a landlord. Because we've all heard the horror stories of, not only maintaining the property, terrible tenants, especially in BC, where the tenancy laws are slanted towards the renters, and it's so hard as a landlord. Once you get a bad tenant, it's so hard to get them out. Whereas Alberta, it's a lot easier. It's the same for Ontario, but yeah, you kind of touched it on there.
Yeah, it's just a fantastic way to invest funds and be part of the real estate market. That's what I love, without the ownership aspect of it.
And you get more control. I mean, like on a stock, you can look at the portfolio and say like, yes, like based on this, it should be going up. But like you said, well, what if something changes and tariffs come in? Well, that's instantly going to drop that stock, where the fundamentals of real estate is, hey, if they're doing this because right now, maybe they're waiting for a property to sell. That's why they need the private funds. Well, you know that, hey, let's say even if it takes a year, well, you're going to be getting your funds back in a year and you're going to get your return on that.
Right. And I always stick back to the an old analogy, so everyone needs a place to live, right? It's a fundamental thing everyone needs. It's a product that everyone wants. And the demand's always there. The demand might ebb and flow a little bit, but that's okay. Versus a stock, a product that you might invest in, that may go down and you'll never recover from it. And that's an attractive proposition. That's what I like about the real estate lending market.
Yeah. I mean, though I do caveat this to my prospective private lenders out there, that it's not as liquid as a stock where, you feel like it, you cash it and that's it. You got to be prepared to have your funds at least a year, if not more, depending. It could be sooner, but
right. And it's something we always advise any prospective investor lender that we bring on is that while the mortgage terms are a year or whatever predetermined term you agree to, it's technically an illiquid investment. It's not something you can liquidate easily. There are mechanisms to sell mortgages, in the middle of the term, but it's not practically done. It's not easy to do. And you have to find someone who wants to take that on. And so I always tell people, just assume you're going to be in that. If it's a 1-year term, depending on the payment performance, you will be in there for at least a year, and if not longer, if you have to go through the foreclosure process, which luckily is quite limited.
And you can tell me, Mark, you can also people can use the RSPs, right, to invest in private mortgages also.
Yeah, and that's a really attractive place to lend from, and glad you brought that up. Actually, there are self-directed RSPs and trustees that will hold RSP funds for the purposes of putting in direct mortgage lending transactions, and Mix as well. So Mix is a mortgage investment corporation that brings in all the funds and then will invest into the real estate, into mortgage deals as they come up. And it's a great mechanism to have tax deferred income coming in into your RSP, and with a low risk profile, which is really attractive.
No, exactly.
Mark, can you tell us what your typical investor profile like? Are we talking about institutional lenders, mom and pop, wealthy business owners, individuals? Who's your typical profile of an investor?
Yeah, so I would say on the whole, it's people that have retired to some capacity. We have a lot of business owners. We have a lot of individuals that have retired from their jobs. We deal with a lot of lawyers that want to invest funds, professional service companies, like I should say accountants, people that were in those fields and understand real estate to some degree. They form the majority of our investor base. That's just who we have in our group, lender group. But I think that also fits for a lot of mix out there too, what their investor base is. And one of the things why we attract so many business owners or previous retired business owners is because on the direct mortgage lending side, the lender gets to make their own decision of whether to invest in a mortgage. It's the differentiating part of what I do versus maybe a mortgage investment corporation does. Investment corporation, you give your funds over to the fund, and then a management company will manage those funds and deploy capital into various mortgages. versus what I do is intake capital, individuals' capital, and put it into mortgages. Now they get to make the ultimate decision whether to invest in on that property, those bores, that location. And I think because of that, business owners, they want to retain some form of control. And I think because they're so used to running a business and having that control, they don't want to relinquish control over their capital now that they're, either retired or looking to downsize, I guess, their management, daily management of operations and whatnot. So then they get the opportunity to invest their money the way they want to invest it, and that's a very distinguishing part of what I do versus a MIC.
Yeah, so individual investors, they become the bank. Like their names are going to be on title as the mortgage for the property.
Right. Yeah. So they get registered. Either their personal names are registered right on title under the mortgage, or if they lend out of a corporation, there's lots of different forms of entities that they can lend from, or lenders can lend from, and they get registered right on title. So it's a very secure, very, very secure way to lend money secured by real estate. And the land title system here in British Columbia specifically is amazing. Is really good.
Let's talk. We talked about first, second, and third mortgages. Let's just kind of explain to people of like how the security works. The first person, when you get a first mortgage, they are the first one. If the property goes into foreclosure, they get their funds. The reason why the rates and everything is higher on that second mortgage, people, is they have to wait until the first person gets their funds to get their funds. That's the same thing on the third side. That's where third mortgages are just like, they're very far in between, and they're going to come with a very high cost to protect that lender because they're going in third position and they have to wait for those two other people to even get their funds out.
Right. Yeah.
I have one time in my career did a third mortgage, and that rate was 14%. And so I was talking to my client, it's a lot cheaper for you to consolidate and do a first, or at least consolidate the second and you do a second. But she didn't want to break any of the terms on the first two. And the property was totally a speculative play where she bought it, and the property was slated for redevelopment, the whole building. So it was essentially, she was okay with it because she was essentially buying a lottery ticket. And so that was the one time I had a client did a third mortgage at 14%. I'm like, just letting you know, this is high, but you're better off doing it the other way. But she decided just to go with the third.
Yeah, I mean, thirds have a place in the business. It's objective-based lending. It gets from borrowers from point A to point B. And yeah, to your point, it has some higher risks around it because they get paid out last, and but it's an opportunity. Some lenders like that risk and are comfortable with that risk that risk profile, and happy to take it with a commensurate rate.
For our audience out there who might be interested in investing in private mortgages down the line, what's the minimum a person has in order to invest? Like, is there like a starting amount, like 10,000?
Yeah, so
20,000 or.
Yeah, it really depends what mechanism and how you want to lend. So in the business, I would say, I won't speak to every MIC, a mortgage investment corporation that's out there for private lending. I've seen amounts, even just $10,000, you can throw a note into a MIC from your RSP, or from cash resources, and then in terms of, for me personally, we tend to deal with individuals who have high net worth. So I would say, practically speaking, it would be a minimum of 100,000, but we have dealt with people that have less. But it becomes, but for the most part, it's higher net worth individuals, I would say. And, but there's no minimum. It's just really dependent on the profile of the client, the lender, weather, and all sorts of things.
So it sounds like, yeah, if you only have 10,000 to invest, then you'll have to put it in a MIC, i.e., almost like a mutual fund for real estate.
Right.
And
Yeah.
you relinquish the control because you don't have enough to have the control. Whereas if you want to be a direct lender and have your name on the title, then yeah, at least 100, maybe less, but it'll have to be a second mortgage with a smaller amount or something like that, right?
Yeah, exactly. That's easier to place. The problem is the size of the first mortgages, for example, are so large now. With real estate, with where real estate values are in BC, that it becomes prohibitive to put in chunks of $50,000 at a time. Versus like you mentioned, if you do a higher rate second mortgage that maybe a client needs to pay off some $50,000 of credit card debt, then certainly we'll be happy to place $50,000. And if that was the lender's only funds available, then that may be the deal for them. But that comes with additional risk, right? So, and I always encourage lenders not to put all of their capital into one deal, and all of their capital into the mortgage market, because, like we said, it remains an illiquid investment, right?
Mark, where is like the place that you kind of serve the most? Like, are you all across Canada? Do you have a preference of like the properties? Like, what do you like to do that way?
So we're licensed in British Columbia. We were licensed in Alberta as well. I actually dropped licensing in Alberta to focus in on BC specifically, and that was just due to demand. I felt that I was getting spread too thin. So, you got to stick to what you do well, and so we refocused in on British Columbia as our place to do business, and we'll evolve back over to doing Alberta, I suspect, and not too distant a future here. But for the meantime, we're just in BC, and specific areas in BC, which I think is important to note. We'll lend in the Lower Mainland, the island, all over the island, the interior of British Columbia. We'll do a little bit up north, depending on the town. Prince George, that's a city we'll go to, and smaller towns. But as you get to more rural locations, the risk gets much higher, because of demand, supply and demand of real estate gets, there's larger swings in those real estate markets. So we tend to either avoid certain locations, or if we do go into those lending locations, we'll be more conservative, and which means that we won't lend as much to the against the value of the home. So it's really,
What do you think is the average, Mark? Let's say like in a main urban hub, what is the average loan to value that you like privates would lend out? And then say more of a rural area, what is the average loan to value?
I think this standard, if I was being standard industry wide, will go. Most lenders will go up to 75% of the value of the home in larger urban centers. As you get to more rural centers, you're probably looking at getting as low as 50%. But there are exceptions to the rule, and there's a wide range of lenders that will go in those locations and the different loan to values. And then outside of, even in urban centers, you'll find some lenders that will go up to 80%. I've seen deals go up to 85 on some occasions, but they come with much higher rates. So it's all over the map. For us personally, we go up to 75% loan to the value of the property. And on occasion we'll go a little bit above that. If a borrower's, covenant, which means their ability to pay, is very strong and good credit, we may go push those boundaries. And that's what I mean is the circumstances may arise that you can go outside of those areas.
That's so
Yeah.
different with mortgages. There's no, like, we want it to be standardized, but like there's just no way to standardize it because every person
No.
is different. And that's where I know that we'll talk a little bit in here, but like about AI and stuff. And that's where, like, yes, some of the business will probably get eaten up by AI, like very like, hey, if you are a salaried employee, you make X amount of money, you've been at that job for 10 years, the AI can do that. But like when you have a very complex deal with let's say 10 different like borrowers or properties involved, it's never going to be able to do the analysis in the right way.
Right. And a lot of the business is just a comfort level. And it's hard to teach AI what makes you comfortable from a adjudication in the adjudication process. Sometimes it just comes down to feeling whether the deal profile works for us and then consequently for our lenders. So
Yeah, that's what I mean. Like when we're talking about values and stuff, what the lenders are going to be looking at is like a purchase price, but they're also looking at an appraised value. And every lender is a bit different. I know certain lenders, their Mark won't use certain appraisers. There is a guideline, but sometimes some appraisers might go really high, other ones might go really low. And for private lending, they want someone to be at the most conservative.
Right, and you touched on a good point, is that there's an incredible range of appraising standards in, especially in British Columbia from what I've seen. I've seen the same property being appraised for $300,000 and $400,000 in difference. And when it's really important to work with people that understand that. And in our business, we generally speaking request and demand certain appraising firms to appraise the property to ensure that we have a conservative lending appraisal, a fair one. I think it's important to be fair, but it's also very important to have a very good appraisal. And I see a lot of marginal appraisals, especially right now, because there's not a lot of sales, and appraisal values rely on comparables, which comparables are recent sales of properties, and there's not that many of them. So it's very easy to run afoul, and not have a quality appraisal because of the lack of comparable data.
Yeah. Mark, can you explain, like, what's your most common lending situation? What's the, is it debt consolidation? Is it like salvaging a pre-sale that's, bank financing got pulled under, or what are the most common things you see that come across your desk?
Yeah, there's three more common ones. I don't know that one overshadows the next one. But the three more common ones are debt consolidation. So we'll have clients that have, couple $100,000 of credit card debt and, or less or more, and we'll pay that out to a lower interest, second mortgage, or maybe it's a first mortgage if we're paying out a existing first mortgage debt. And then the second one is purchases. So we do a lot of pre-sales. So, clients who bought 3 years ago and having to close, and they may have thought, I'll sell the property before I have to close, or their personal circumstances have changed. Incomes have changed, loss of jobs, sudden loss of jobs, or family members are overseas. There's all sorts of reasons, and we'll come in and finance the purchase for those clients. And then the last one is more business loans, and business loans are, clients need to add cash flow to their business. Maybe their demand is slow right now, so they're buying inventory. We've recently did a mortgage for a bike shop owner. They wanted to buy more inventory. And that's an example of a business loan. So we secured the mortgage against their personal principal residence and allowed them to go and buy inventory. So that would be a bit, the nature of the funds is for business use.
Mm-hmm. The other nice thing about privates, and on the commercial side, this can happen, but what is called an inter alia mortgage. Let's say that you have a property free and clear, and you're now buying a condo that is now worth less in value. That's obviously where some stuff is coming in for people. And now, again, if you could qualify and take equity from your house, well, you'd rather just do that, buy the condo. A lot of these people never qualified for these condos in the first place. They never should have bought them. They're, I'm not going to say realtor, but someone told them, hey, don't worry, you're just going to sell it and you're going to make money. And they should have known that, hey, what if you can't close on it? Are you able to qualify elsewhere? And that's where a private lender can come in, take the equity from your house. Let's say it's worth $1 million. They have access to that $1 million and the 500,000 in the condo. And that's how you're able to obviously bridge more money to assist in that way.
Yeah, that's right. And we do lots of that. We do lots of deals where there's, collateral security, inter alia security over a principal residence to close on a purchase. It may be required to do that for to meet their financing goals, especially now with the condo market having softened up. We will often take inter alia security over another property, their principal residence or a rental property, in order to just tie up the deal and have additional security in light of poor sales on the condo market and especially the pre-sale market. We've seen a downswing in real estate values on the condo market, and that's across Canada. I think the effects are more prominent in Ontario, but we're seeing the same thing here with a huge glut of condo supply, and more to come. So we're actually being, a little bit more careful of the deals and deals we're doing on condos, and maybe pulling back or requesting additional security, or just simply saying no to some deals on condos for the same reason.
Can we ask one so let's say I have a mortgage at TD. Now obviously we won't get into the full legality of this because this is the lawyer's job. But how does it work? Like if I have a first mortgage with TD and I need that secondary financing, how does that work and everything?
Well, I haven't seen any bank lenders allow second mortgages outright, and I think that's important to note.
In their contracts it says no secondary financing.
Right. Now it's whether that lender will enforce that clause or not is up to anyone's guess. I've seen, based on my own experience, I haven't seen any residential mortgage be pulled, which means foreclosure started due to a second mortgage being registered. I have seen it regularly on the commercial side, with lenders reacting to a second mortgage being registered behind their loan, and they will then initiate foreclosure or demand for their funds back as a result. So I just always advise. So in those cases, the important thing is to always advise clients that risk is always there. By acquiring a second mortgage, you are always, mostly, if not always, running afoul of the terms and conditions of your first mortgage. And it's up to the borrowers to make that choice. And they can, with the right information, they can make that choice for themselves.
Now we can either remove this or keep it. Like, why do you think the government and everyone knows, like the regulators know this type of lending's happening? Like, why hasn't this stuff been changed to like make it legal? Like, I would say, why are regulators allowing second mortgages, in a sense, even if they know that it's not per the contract?
Well, because that's a contractual obligation between bank and borrower. That's not a and so that's up to the lender to enforce that rule. I'm not so sure a regulator needs to intervene in a decision.
Yeah, and so I don't
contractual decision between.
I don't mean that, more the banks. Like, why have they not like either been like, hey, this is not allowed, or hey, like changing the standards? Like in the US, like it is legal to have them. Like I just find it very funny that it's a gray area. I find Canada is so much more gray.
Yeah, it's almost like contractually we don't allow it, but if you're going to do it, we're not going to enforce it. So why bother having it in the first place?
Well, I think they reserve the right to be able to enforce it as they want. I mean, um, I don't. I mean, I share I share in the fact that it's a bit silly, the way it's in there, but they don't enforce it. But I do see it enforced. There are certain product categories which it doesn't seem to be enforced. I haven't seen a residential mortgage get enforced with a second mortgage being registered, but like I said, I've seen it on commercial deals. It's just a nuanced thing. I don't know why it's not enforced. Just the way it is. Could that change? Yeah, I could see A lenders, going in especially in this market, if there's a substantial retreat in the real estate market, real estate values, I should say, they may start enforcing, those rules, and because they're getting a little bit uncomfortable about their security. And they'll reserve that right. So I don't think they'll ever give up that. That'll never change. I don't see why would they?
Mark, you kind of touched on this earlier. What's your take on the current real estate market? I mean, we all know that the pre-sales are pretty dead and no signs of it turning around anytime soon. So like, are we going for like a, 5-year bear market, or do you think this will recover sooner than we think?
Well, I'd be a multi-millionaire if if I had a magic ball to tell you that. I think the simple word is variable. The market's variable. It's not very predictable at the moment, and that's causing a lot of buyers to sit on the sidelines and or if they're going to enter the real estate market in some capacity, they're waiting for a deal. And you've got sellers who are looking to sell, but they're kind of entrenched in their expected return. So it's everyone's a bit of a stalemate. And then you're seeing the rug get pulled under from some people, with regards to, there's not as many buyers for condos, and so condo values have come way down, and there's a lot of supply again because people aren't being forced to sell yet. But it's coming, and so that's it, and it's really hard to predict where things are going to go, because right now there's not a clear indication of rates coming down, and there's not and right now there's upward pressure on borrowers' ability to pay, due to inflation and the current market, and there's all sorts of reasons for that, and so it's making it's making buyers weary about buying, and consequently there's just more product on the market, creating more variability in the real estate market as a whole.
Yeah, I see a lot of sellers talking with a lot of realtors. There's a bunch of sellers that are still living in La La Land, that they think their values are still at COVID highs. And I'm like, pardon me, the whole country has dropped about 15% from the peak. So, unless you really, really need to sell, then you better drop your pricing. And we're hearing stories from all our colleagues that they've even had to turn down listings because dealing with unrealistic sellers that they know is not going to sell at that price. And, they're shelling out $1,500 to $2,000 out of their pocket to market it, put it on MLS, photography, floor plan, and all that stuff. And they're just, this is a weird time. We're actually saying no to listings, which the world has turned upside down in real estate. Whereas back in the heyday, listing is gold. Now it's like, I'd rather not.
Yeah. And that's just an imbalance in the market at the moment. That will correct itself eventually as sellers are forced to sell, and it will create new benchmark pricing in certain product categories. It's like condos. If there's 10 condos that are identical, price is king. So once that first person sells, that'll create the new benchmark price, and then everyone has to follow. Now there will always remain people that can and hold for a longer period of time until they get their price, and that's great. They can do that. They can afford to do that. But there are a growing number of sellers, that are from what I've seen, are now they have to sell. They can't hold onto their properties, and those are the people that will be forced to sell their properties at a lower price, and so that will start the process of declining real estate values, which has already begun, and it's been like that for a year now.
Yeah. We have a couple of buyers in both of our businesses. I say to them, man, this is the best time to buy. There's so much product out there. Like, you can find a deal. Not everyone's willing to play ball like that, but you can find a deal. Now, at the same time, because there's a lot of choice, there's not much urgency. So don't take too long, because you never know when all of a sudden there's a little sense of positive news in the market, and then all of a sudden there's an uptick. Now that's multiple offers again. Now, I'm not saying it's going to happen, but we've been in the business long enough to know that there are buyers out there that have had analysis paralysis and have waited too long, and they missed the boat, or they missed their boat, and they ended up buying at a lot higher down the line. So
yeah, that's absolutely correct. Yeah. I mean, it's just it's an interesting market, filled with opportunity, for buyers, and sellers can sell with the right mindset. And you have to create a unique product out of your property. And I think, if there's a lot of the same product, price is going to be your most important thing that you can, of how you can affect change, and sell a property.
This is the fun part of the episode. Do you have any funny, crazy stories of lending situations that you want to share with us?
Well, yeah. I mean, I try to think back of a few stories. I mean, I have some probably couldn't even share here, but those are for over a beer. But I can a couple of recent ones were actually quite similar, and I think it's actually kind of funny because they were clients that had OnlyFans. One that's more recent, it was a couple that did OnlyFans videos, and it was unbelievable how much money they had coming in. It was ridiculous. Should we all change careers here? Like at this.
So it's not pictures of their feet, right? It's
no, not just the feet thing. And so, they were new to the game. They wanted to buy a property, and there was some deep urgency to own a property, and we financed their basically their purchase. And the reason they couldn't get qualified because they didn't have enough tenure in the business, so to speak. There wasn't enough history with their success. We just had to make sure that they had good money, cash flow coming in, which they did. It was an unbelievable amount, and so it wasn't anything too crazy, but didn't have to do any due diligence on that one.
Yeah. I'm pretty sure the banks too, they have a morality clause. It's almost like you're not a drug dealer, but you're the part of society where we don't want to associate with this because we have to answer to our shareholders. Like, hey, you're lending to this. Are you promoting this? Yeah.
Again, like, this is like the best, like this is the most legal and safest way like you can have
Right.
it. Like, and it is a business, and that's where, like, we've seen it. As long as they have a 2-year history and a self-employed income, it can happen at that time.
Right. Then that's an established method of earning an income. So, it's a bit new. It's I guess niche and growing, but niche. I forget what they made, like what OnlyFans. It was insane amount of numbers, and I mean, a lot of them are just like photos. Like, some of them aren't even, like, we're not talking into stuff. It's pretty crazy. Oh yeah. I mean, a real gambit of stuff. I've seen all sorts of. I've seen all sorts of clients come across our desk in various industries, and as long as it makes sense, it's legal. It's and that part's fine. we do our due diligence to make sure that there's, no funny business going on. And, now we've always been very careful about, all the new regulations and especially now, even more due diligence has to be done to cover money laundering and protect against the public against that. And so there's a enhanced, even more enhanced due diligence to be done now. But yeah, no, those OnlyFans clients were above board. They were fine.
Wow. It could be the same thing of like an erotic dancer too, right? Like,
Oh, we've had that too.
legal, but like no bank will touch it because of the same, the stereotype. They'll like,
Oh, yeah.
we know it's there and some of us might frequent it, but we're not going to lend on it.
Yeah. Well, that's okay. And as long as it makes sense and they've got the ability to pay, hey, you do you.
Yeah.
So we're okay with it. It does give us a laugh as we see the application.
Heading out to your lenders saying, "Hey, you ready to lend on this one?"
Right. Yeah. Exactly. So yeah. There's a little more description to tell, I guess. But yeah, no, it's all good. So yeah, we see lots of clients like that, and just oddball professions, you name it, and that's what makes the job actually really enjoyable. It's the variability of it. We have different clients, different deals. Every day is different. I get all sorts of funny, crazy stories, great stories, great success stories. I've had, people that are going to get huge windfalls from, I've seen lotteries from, but the money hasn't come in yet, or certain cases that they've won, but money's not in yet. Really interesting stories and backgrounds. And that's what makes the business so fun, and being in is every day is new. That's
So I have an interesting question. I didn't have a chance to ask you beforehand. Are you able to lend against an inheritance that hasn't been divided up yet? Like, let's say it's still within probate and certain money is expected to,
right.
Let's say myself, but we're waiting for probate and all that stuff. Are you able to lend against that?
Yeah, I'll tell you a couple of interesting circumstances that deals we can do. So one of them is, like you just mentioned, is an estate. So let's say there's an executor of a will that's registered on the title, and the maybe as it's going through probate, there's a need to refinance, maybe to cover the expenses of the estate, or cover real estate, property taxes and other costs, or maybe the beneficiary of the estate wants some funds out, and as long as the executor that's registered on title has the ability to mortgage a property, which I would say most of them do, then we can provide funds to clients in those situations. But then the other one, which is interesting, which is a little bit different, is we'll do in British Columbia, you can do half interest loans, or partial interest loans, which is very interesting. And so if, let's say, a husband and wife own a property, or a brother and sister own a property, but one person wants to lend against, borrow against their interest in the property, you can lend against a partial interest in a property. In British Columbia, it allows you to do that, and it's another way to access funds when a property's owned with another person.
Sounds good. We've gone a long time, Shanks. Any closing thoughts? Any closing questions for Mark here?
My question would be, is obviously when we talk about like the bad apples in the industry and stuff, is like, do you get files that sometimes come across your desk and you're like, well, for one, you sniff it out and like, well, like this could work at an A lender. Why are you bringing it over here? And that's like, we get it. We get it. Like I get deals after that have been in a private, and for one, sometimes it's nothing fishy. It's just a bad broker and they didn't even know how to structure it. and you get in, you're like, why were you ever in a private? Or obviously seeing it where they're trying to do something shady, they're trying to bring money in, they're trying to launder it that way. Do you see those and obviously fish it out?
Oh, regularly. Yeah, yeah. We see all sorts of crazy files. I mean, we've seen fraudulent files come across our desk. So just on that topic, yeah, it's sometimes just a nuanced thing to sniff out what doesn't add up. I mean, sometimes there's really good fraud being done, and you no matter what you do, you can't figure it out. And so, it's important to just as best as you can, if it doesn't pass the smell test, don't do it. And we do sometimes say no to deals that on paper and structurally they look perfectly doable, but we ultimately just say no, it just doesn't quite add up. So we'll just turn those deals down, and that's okay. And that's a good thing. Again, and to your first point, which was, we see a lot of deals where this doesn't make sense. Why is this here? Why was it private in the first place? But we're not party to those original transactions. So I don't pass judgment because I don't know the circumstances of that situation. Right. So, yeah.
Sounds good. Well, Marc, before we let you go, where can we find you? Like, do you have social website? Like, where can people find you? Or if they're looking to invest their funds?
So if people are looking to invest funds, the best place to start is my website. You can go altmanfinancial.com, ALTEMAN financial.com. That'll get you to the website. And for the most part, this business is done by a phone call. So people can give me a call, numbers again on the website, and they can track me down. And, if there's any interest in the business or just want to have a conversation about real estate lending and real estate, I'm always happy to. I love talking about it. So I'm always happy to help, and appreciate you guys for having me on here.
Yeah. Thanks a lot for coming on, Mark. It was a great time.
Yeah, absolutely.
That's great. Folks, this has been Marc Alteman from Altman Financial. Marc, thanks for joining us. Folks, we'll see you next time.
Now, if you enjoyed this episode, make sure to like and subscribe. If you're listening on Spotify or Apple, make sure to follow us. Please give us a 5-star rating. You can even send us an email because we want to know what you guys want to hear about. That's what we're here for. Reach out anytime.